Hello everyone, how's it going? In this video, we're going to be talking about Palantir, trading under the ticker symbol PLTR on the Nasdaq. If you're looking to buy Palantir stock, then please keep watching this video because we will be looking at the company's recent news, how's the market treating it, and what are the technicals telling us. We're also going to try to figure out what is the best approach to trade the stock in the current conditions. As the market remains very volatile at the moment, we should always be careful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few years, Palantir has been able to showcase its incredible resilience in terms of popularity, willingness to innovate and to captivate or to, bandwagon on the ongoing trends, and its goals of becoming profitable or at least balance the books. Overall, the company has been able to survive its lows, as we have seen all over the years of 2022 and a good chunk of 2023, and are now trying to go back to their former glories. It doesn't mean that Palantir can necessarily climb back to $30, $40 in the short term or in the current market trends. But the narrative has always been there, and it's always ready for the takeoff when the wind blows in a different direction. With that being said, right now the market hesitates between keep climbing and pausing a bit in order to digest the profit taking. So personally, I believe that a company itself deserves to have a long-term perspective. That being said, let's also take a look at the technicals of the stock. The trading volume of Palantir has recently been around 38 million shares versus the average volume of 50 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $20.24. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be easy to influence the stock price. But low liquidity can also mean that the demand is limited too. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or a breakthrough if the difference between the two is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently around $33 billion, compared to the enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is around 10% higher than the 1-month low, 12% higher than the 3-month low, and 160% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility here is around 52% versus a historical volatility of 65%. The put-call volume ratio is around 45%. It is normal for many stocks to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 180,000 contracts a day versus the 30-day average of 270,000. In terms of open interest, the most recent volume of open interest is around 2.4 million contracts versus the 30-day average of 2.6 million contracts. In terms of shareholder structure, institutional shareholders own about 35% of the current outstanding float, likely as a result of short selling of its outstanding shares. The biggest shareholders include Vanguard, Renaissance, and State Street. Usually it's best to see some institutional participation when holding a stock for the long term. In my case, that is indeed my intention, as long as the stock, in my case, actually, I've liquidated my position a while ago, and since then I've hesitated coming back simply because I feel like the price might retrace in the upcoming price correction, which didn't really happen on the Nasdaq. Now, institutional participation does offer a layer of stability. It means that the market is confident that it will deliver value in the long term. In fact, not just value in the long term, it is currently delivering value, all right, which is an important factor to consider for the investors. I personally consider that the minimum threshold should be around 25 to 30% of institutional ownership, which is the case for Palantir. Although there are many exceptions to this rule, there will always be great companies, mostly owned by retail traders. The current short interest is around 8% of the total float, and 46% of the transactions coming from the dark pools. Typically, if the short interest is above 15% of the total volume, with a significant portion of the shorts coming from the dark pools, it may suggest that there are institutional positions taken to short it, and that there would be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. Overall, I think that Palantir is a good stock to buy if you don't have any, and to slowly trickle in over the next 12 months or so. In other words, Palantir is really here to stay, as long as people need big data and analytics tools and platforms in pretty delicate situations where purely commercial companies and partners may not be willing to get involved. This is where Palantir is really head and shoulders above everywhere else, and this is also why they're able to secure public sector contracts. And this is why I think that they deserve to have your trust in the company over a multi-year horizon. I would recommend to commit between 3 to 5% of your portfolio in the stock and to split it over the course of next 6 to 9 months.